let's look at some different metros. Remember, I talked about people capitulating when they buy a house, right? Well, here is an example. So I am showing a map on the screen of the metros with the highest share of mortgage holders under age 30. And here are the cities: San Antonio, Oklahoma City, Nashville, Louisville, or if you're from there, you're probably saying, I'm not pronouncing it right. I got to put marbles in my mouth and say Louisville, Cincinnati, Indianapolis, Pittsburgh, Virginia Beach, Buffalo, and Hartford. You know, when I was in my 20s, I remember people in their 20s and they were buying properties in beautiful Orange County. Okay. They were buying properties in tier 1 cities, super desirable markets. But what did all the people in their 20s do? They capitulated, just like I just said. They adjusted their expectations and they said, look, we can't afford a home in New York City, LA, San Francisco, Seattle, Orange County, San Diego, right? We can't afford that. And when I say Orange County, I mean Southern California, Orange County, the expensive market where I'm from. But anyway, you look at these cities where people under 30 are buying homes, right? Where they've got the highest share. And it is not these tier 1 cities anymore. I mean, Buffalo, New York is definitely not a tier 1 city, okay? I don't think anyone's growing up in Los Angeles or in San Diego saying, I'm 13 years old and my goal is when I'm in my late 20s, I want to buy a home in Buffalo. Just saying. Now, sorry, Buffaloians, because guess what? That's where my family's from, upstate New York, between Buffalo and Rochester. And as a young kid, I don't really remember much about it, but I used to live in Rochester, actually. So Buffalo, Rochester, I know that area, okay? Anyway, this is the point of capitulation. This shows you that people adjust their expectations because they can't afford a home in LA or Miami or New York or Seattle or San Francisco or any of these places. But they used to be able to afford that. They used to be able to afford these tier 1 areas. This is what inflation does. It destroys the standard of living. But oddly, the standard of living, actually, even though it's less expensive, may be better in some of these places. I mean, we don't have to talk about what's happened to many cities in California with Gavin Newsom ruining them, with a homeless population, with a crime, it's just out of control. But that's another topic. Okay, remember, the one thing you absolutely positively must have if you want to have a real estate crash is you must have tens of millions of homeowners that are in dire straits, that are in desperate circumstances, that need to sell their home. And we have the exact opposite of it. Those tens of millions of people need to turn into millions of people that actually put their home on the market and are willing to accept any price they can get. And we have the exact opposite of that, as I've been talking about for several years now. We have tens of millions of people who are extremely comfortable, that have cheap mortgages, that don't want to sell, that don't want to move, that aren't giving up their homes because their home is too good a deal, right? That's what we have. Look at this article. This is from Mike Simonson, who's been on the show many times before. In fact, I just had dinner with him a week and a half ago in San Francisco when I was up there. Mortgages may be the sunny spot in a cloudy U.S. economy. New FHFA data shows that, did I say FHFA? I think, yes, I did. Remember, the brain ain't what it used to be always, right? New data shows that the current mortgage borrowers are in a strong position to weather an economic downturn. And they are. Remember that study I did a couple of years ago when I was saying to all of the crash bros and all of the doomers that they were wrong? And they were wrong because look what happened. Where's the crash they all been predicting, right? Just didn't happen. So all of these doomers told me that I was wrong and that there would be a real estate crash because massive unemployment was coming. Well, that didn't happen. They were wrong about that. Now, hey, the jobs picture ain't quite as good as it was. And I know it's manipulated, but it's always been manipulated. Okay, so compared to what, right? If they manipulated it in 1980 and 1990 and 2000, 2010 and 2020, they're still manipulating it. Okay. It's just the manipulated data compared to the manipulated data. It's okay. All right. Now, with the CPI, otherwise known as the CPI, that manipulates the inflation data, we've talked about that many times. With the CPI, that manipulation actually did significantly change right around 1980. Talked about that in past episodes, won't go into it now. But what I proved with my little study I did is that all of these people that own the 140 million homes in the US could afford the home they had and the mortgage they had based on unemployment income. Government-sponsored unemployment insurance, they would literally qualify for the mortgage they have today because their mortgage is so cheap that they wouldn't have to sell. They would not be in distress. Remember, the one thing you must have is tens of millions of distressed homeowners become millions. Now, not all of them turn into sellers, right? Who become millions of distressed home sellers. We have the complete opposite of that. Okay, here is the loan to value ratio for US mortgages. It's only 47%. That is the average loan to value ratio of outstanding mortgages. Back in 2013, the average mortgage was over 70% LTV. And it has steadily gone down, down, down. It leveled off during the pandemic boom, and it's gone down even further since then to only 47%. This is the equity cushion people have that means the market, if it did crash, which I don't know how it's going to crash based on all this data I'm giving you, but if it did, say the market went down 20%, people would still have 27% equity in their homes. I mean, it's just a non-starter to be a crash bro, to be a doomer. It just didn't happen. And the data is still supporting a strong but slow market, okay? And probably a little slower than before. Now we'll see, the Trump administration is a wild card. I told you that this year was the hardest year to predict of my entire career, what's going to happen, because we have a very, very disruptive administration running things right now, and it is a lot of question marks. But look, go back to the fundamentals, right? The great American cash cushion, 82% of borrowers have at least 30% equity in their home. And I'm showing a chart on the screen. If you're listening on audio only, I'm showing a chart that just shows each tranche of equity. Virtually nobody has negative equity, okay? Everybody has positive equity, the worst being in the 20% equity range, and then going on down from there into, well, when I say down, I mean more and more equity, meaning the average is 47% LTV. That means 53% equity. Oh, by the way, when I told you that number before, I did that backwards. The loan against their property is 47%. That means they have 53% equity. So if the market went down by 20%, they would still have 33% equity, not 27%. I was mistaken there a minute ago. It's better than I thought by 5%. Okay. So it's pretty darn amazing, the dynamics of the real estate market. Here's the outstanding mortgages by interest rate. And you can see that people have very, very low rate, very comfortable mortgages. However, there is something interesting about this. Remember those 4 million people a year for the last 3 years that have been buying houses? Well, they have higher interest rates. And so interestingly, and if you're looking at the chart with me, I got to try to always explain things for audio only listeners because, well, that's most of our listeners. And I love you. Keep listening on audio only. I love the portable format. It's great. But if you have a chance, grab these YouTube videos and just so you can see the charts. So here you see the pandemic era, right? And during the COVID era, we had very few mortgages that were 6% or above. But that number has actually increased to now where we have about 20% of the mortgages that are 6% or higher. So that's interesting. Why did that happen? Well, because 12 million people bought a house since the rates went up, give or take. It's not an exact number, back of the napkin math, okay? But that is actually, interestingly, positive sign because those people were underwritten in more harsh circumstances than the low rate people were underwritten. The low rate people, they only had to qualify for a very low payment. So you see how that works? Okay, interesting to note. I just want to encourage everybody to try things and to do more things. And I saw this Babe Ruth quote and I thought it was great. Every strike brings me closer to the next home run. And that's how life is. It's number one, on the job training. We got to just go out, take risks, make things happen, and just understand that every time we fail, as long as we're failing forward, we are getting closer to the success we seek. I remember when I was a traditional realtor, a very young one, I remember listening to a sales trainer by the name of Jerry Bresser. He was a good sales trainer, very old school guy. I had his cassette tapes, and he would talk about how you should stack $25 bills on your desk, right? And every time you make a cold call and someone hangs up on you or, rejects you in some way, move it to another pile. Have these two piles of the $5, right? Because you got closer and closer to success the more you failed along the way. And that's the way it is with everything in life, right? We got to just keep trying. We got to be optimistic, and we've got to just keep doing things and keep moving forward. The only people who ever really lose are the people who don't move forward, the people who don't try, who don't, just take the risk to get into things. And you'll never figure everything out before you start. That's just not the way life works. And people, I sometimes see them, they think about, should I invest in real estate or, not? I don't know. I don't know everything. What if this happens? What if that happens? Yeah, it's probably going to happen. Okay, all the this and the that are going to happen to you eventually if you do enough things. But you got to just take more swings, right? And that's the way you get success. I've told you my story before, but I bought my first rental property when I was 20 years old. I lived at home, okay? I did not have a place of my own, but I owned a rental property. And in this first rental property, I put a tenant in there and it was going well for a while. And then the tenant just stopped paying. I would go knock on the door and I would try to collect the rent. And I was a kid, right? And they didn't respect me at all. And so they just stopped paying the rent and I had to evict these people. And that was my first experience. Do you think I would have had every reason to just give up and say, hey, this real estate thing doesn't work? Nobody would have blamed me. They would have just said, I get it. Nobody looking around. None of my friends would have blamed me for just giving up. But I'm sure glad I didn't, because I made many, many millions and millions of dollars since then. And that's why you got to keep going, even in the face of discouragement.